Good day, ladies and gentlemen. Welcome to a Thursday update. I'm glad to be here and glad you're here so we can talk about what's going on. It's April 24th. It's a Thursday. So, a little bit of an update today. I got this gut feeling that something's been triggered within the deep, dark recesses. This last episode we had with the markets and stuff has triggered something behind the scenes we can't see in the financial system. And it seems as though the markets have stabilized. Let's take a look at the Dow Jones today, 39,989. But what I want you to notice, this is a 1 year chart. And what I want you to notice is from the peaks right here, even though we're having these little bounces up and stuff, the overall trend is it's trending down and trending down fast. Unless it breaks out of that trending pattern that it's in right now. So overall, basically, what I'm thinking in my mind, looking at this chart, and I'm going to tell you, man, I've looked at a lot of charts, and you get so you can read them after a while. And this chart gives all the appearances uh, of a bounce. But here's what I want to say, guys: is I believe that we're in for some really troubled waters coming up ahead in the financial system, and I believe that they're going to do what they've always done for the last 100 years: is leverage the system higher. And so I think there's going to be a turnaround point in these markets, after we get done with this little period that's happening now, where they haven't really changed from. They had tight monetary policy all during the last administration. The Fed had tight monetary policy. They were raising rates the whole time, uh, incrementally, generally 25 or 50 basis points to a time. And also at the same time, they were doing something called quantitative tightening, which is very, it puts a stranglehold on the economy. And they haven't really completely released the tension from all of that. And they haven't really done anything to reverse course to a monetary policy that would be more accommodative. No, it hasn't happened yet, but they're going to, and that's when we're going to start to see these markets go up. But the larger the action now in this interim period that's going to force their hand, and if there's something going on behind the scenes in the financial system that we don't know about, which very well could be, it could be happening right now in the recesses of the financial system, where the derivatives products are being held, where in the overnight markets and the money markets and everything else, there could be something going on. And I'm very suspicious that there's a continuation going on behind the scenes, even though the markets have relieved a little bit. They've had several days of relief now, and I got relief today at 383 points. Overall, I think that this downward trend is going to continue uh, on this chart. If we just look at it from the peak, and how I could just draw a line right down that way. Just draw a line. I could just draw a line right down that way. And so if this peak doesn't rise above, say, 42,000, it would have to break out over 42,000. So the market would have to climb over 2,000 points from here to where I would say, yeah, maybe we're in a little bit of a breakout. That's what we'd have to get. And I don't see that happening. I see maybe a couple more good days or whatever, and then she starts trending downward again. This is what I think the overall market is doing right now at this point in time. Um, Now, what's happening in the world is Iran. They're talking about a nuclear deal here, and I told you guys. I said 2 months. Well, the clock's been ticking, and it says if a deal isn't reached, Trump could order a U.S. military strike against Iran's nuclear facilities. Uh, Two sources told Axios that they raised an interim deal proposal. Iran did, and the Iran's mission to the UN denied it in a statement to Axios. This is simply neither true nor accurate. The State Department declined to comment on this interim deal. But they're talking about an interim deal if they don't have enough time to get this through. That's what they're talking about. And they say the 60-day window is very short to try to get through a nuclear deal. I guess they're trying to push it through really fast to avert a war. Well, we'll see if they can get this interim deal or not. And the clock's ticking, and there's not that much time left. What is there, maybe a month and a half or something like that? I don't know the cutoff date. It doesn't say here what the cutoff date for that is. It says, what's to watch? The U.S. and Iranians are working low-level negotiations, and they will meet again on Saturday in Oman for a first round of technical negotiations. This will be the first time that parties will discuss the actual limitations that the U.S. wants to see imposed on Iran's nuclear program, especially when it comes to uranium enrichment. So that's, in other words, that's the meat of the deal. If you got a sandwich, that's the ham in the sandwich, is when they really sit down and start talking about the actual uranium enrichment, how high they're going to be able to enrich it, how just the actual details. You know, they all saying the devil's in the details. Now, we're taking a look at the United States here. This is just like the stock market. It's following something very similar, and this is house sold in the United States. Uh, sales prices. This is it. You see the peak. The peak was in the fourth quarter 2022, so basically around the start of 2023. And you can see it's doing exactly the same thing as the stock market. It's bouncing up and down, but the overall trend is downwards. The same with the stock market. And I see this overall trend continuing until something is done to relieve the monetary pressure on the system. The system's going to continue to keel downwards. And, you know, it will, in the end, head toward deflation. Take a look. Where did I have that chart here? I had a chart here. I think this is it. The Consumer Price Index year over year. You can see that we did have a little bout of deflation in 2008. This one little spot right here, is negative 1.3%. Back in, it was actually 2009, 7th month of 2009. Just a little point of deflation right there, just after the great financial crisis. You can see the inflation now. These two big spikes over here on the left-hand side of the chart is the 1970s. 1975, in around that period, 11.8% inflation. 1980, 14.7% inflation. And moving out, we can see that they were listing at around 8.3 or 8.6%, the inflation that we had just had, this spike on the right. So the spike on the right is the one we just had. You can see it wasn't as bad as the ones in the 1970s, but then again, you have to consider that the way they tally inflation in the 1970s and the way they tally it now, it was probably would look on the chart, if they tallied it the same way, it would probably look very similar to this on the chart here in 1980. So we actually probably had right around 14 or 15% inflation in this spike over here. But it's the way they tally it is why it's not such a big spike. But it's probably the exact same inflation we had back in around 1980. But you can see it's tapered down, and now it's supposedly listed at 2.5%. And what it really is, it's probably really more like about 5%, something like this little spike right here we had in around 1990. You know? That's where it is right now. It's probably around where it was in 1990. It's probably around 5%, 5 or 6%. They're saying it's 2.5% or 2.9% right now. What is it right now? Around 2.8% inflation according to their metric. It's probably over 5%, 5 or 6%. But it's come down substantially. But as you see this inflation coming down, that's called disinflation. When inflation lessens, it's called disinflation. So we've had some disinflation. We haven't had deflation. See, we only had the deflation back in the great financial crisis in 2009. We had a little bit. They don't allow that deflation to continue for very long, I'm going to tell you. They'll shut the door on that really quick. But the reactionary. The Fed will only react when they actually get deflation. It's coming up. I think there's a little period. That's why I call this a deflationary spike event, because I think we're going to see a spike as profound as what we saw after the 2008 debacle in 2009. I think we're going to see a spike like that, except they're not going to show it on here. And the reason why is they're going to use a new metric, Italian inflation. So if they get like a 1 or 2% deflationary spike event, like I'm talking about right here, and that's where it's heading. You can see it's been heading down ever since 2022. It's been dropping. I think it's going to continue to drop rather sharply here, and I think this hasn't been charted yet. But what's just happened is very deflationary, and I think what we're going to see is this is going to drop right down. I think it's going to drop down below into the deflation, but they're not going to register it. They're probably going to say we still have like 1% inflation or a 0.5% inflation when we really have 2% deflation. That's what it's going to be like. But they're going to react to it as if it's 2% deflation, and they're going to come in and they're going to change monetary policy. Heck, hard to tell exactly if banks are starting to have trouble and stuff at the same time. It's hard to say. They just might go to some sort of a policies where they might bring out something like UBI or something like that, and this would help them to initiate their new digital currencies to get them in place. I think that's what they really want to do. Is they want an excuse to put in something like that. But for now, I guess that's on the back burner. There's a lot of talk about that, CBDCs and stuff. Not so much talk about it anymore. It's kind of dropped off the radar a little bit. Now, the United States Treasury Secretary is saying that a trade war with China is not sustainable. Yeah, it's not sustainable unless you're in a wartime period, and then it's something different, you know. Then they would have to bite the bullet. But ultimately, in normal peacetime, this is not sustainable. A trade war with China, to this extent, where they're cutting off all trade with China, basically. It says Washington, U.S. Treasury Secretary Scott Bessent said in a Tuesday speech that the ongoing trade war showdown against China is unsustainable, and he expects a de-escalation in the trade war between the world's two largest economies. But in a private speech in Washington for J.P. Morgan Chase, Bassett also cautioned that talks between the United States and China had not yet formally started. So this is kind of what's brought the market up a little bit. Stuff like this, him saying that it's not sustainable, so blah blah blah. But at the end of the day, they haven't even entered into talks yet. It says they have formally yet to start these talks, and so there's an import tax 145% on China, which is countered with 125% tariff on U.S. goods. Now this makes up about 15% of the Chinese economy. I'm going to tell you what, if you cut that off entirely, which is basically where I think we're pretty much where they're at right now, they've just chopped it. About 15% of the Chinese economy, that might not sound like much. You say, well, they still got 85%. Yeah, but you chop 15% off of somebody's GDP. Say China's running, I don't know, 5% GDP or whatever, and you chop 15% off of that. They're a negative 10% GDP. That's a depression. So you just can't chop 15% of a country's income off like that and expect things to be hunky-dory in the world, especially when it's as big a trading partner as China. But so I do expect there's some sort of deal in the works that's going to come through at the same time that they come along with a more accommodative monetary policy. That's when we're going to see everything turn around for these markets, is when we get more accommodative monetary policy. This is what the markets are really waiting for. And this is why all eyes are on the Fed, all eyes are on the trade tariffs, all eyes are on statements made about Jerome Powell and stuff. Because this is what the markets are waiting for. they're waiting for relief on all this, and if they don't get the relief that they're looking for, they're going to continue to roll downwards because they have been over leveraged for so long. You don't get any buyers in these markets. Because also the buyers in these markets have been coming into the relief of the market, and they've been buying the dip. They've been buying it, and they're getting burnt. And if you think a 300 a day of 300 up for the Dow is going to make all that go away, you got another thing coming. Bonds and rates today, we're seeing some relief in the bond market as well. We're looking at falling yields here. We're looking at a 10-year that's fell down to 4.3 on the 10-year. And that's the most important one. It fell 7.8 basis points, which is a fair good little day down, Some relief on the bond market. So this has been a brush fire, and now it's finally getting a little bit of a sprinkle of rain, but it's not the big rain that would put the brush fire out. It's more or less just a little sprinkle and a little bit of cooler, damper air. It's not really putting it out. But it's brought it down a peg. That's all. Okay, so taking a look at our dollar index, and the dollar is basically going along sideways today. It's awful tempting. You see this deflationary spike event playing out right now, okay? It's awful tempting to get into dollars because there is going to be a point, in this event, I think just not too far down the line, where you're going to see everything rolling over and margin calls and everything else, and it's going to be, but it ain't going to last. It's going to be so short-lived that maybe if you're some sort of a trader that's got his finger on the button or got some sort of a robot to push the button for you 24/7, maybe you can make some sort of a profit from this by being in dollars and then switching out just at the last minute when the dollar goes over the hill. But if you're a normal person, I would say to avoid them because this thing's going to be so short-lived. It's going to be this little transitionary period where everything's starting to roll over, and then the Fed comes to the rescue, like the big heroes, and prints a whole bunch of new money and goes to accommodative monetary policy. And then Trump makes some sort of a trade deal all at the same time. And then you're going to see the markets shoot up. You're going to see everything shoot up. And the dollar go, phew, goodbye at that point in time, So, but up until that point in time, while we're going into this, fire truck just went by. As we're going through this little point in time right now, as everything is kind of drying up because they haven't given enough money, it works just like a big potted plant out in your yard, and I mean the leaves are drying up and falling off and everything else, and the soil's dry because you forgot to water it for weeks after weeks. That's what the financial system's like right now. It's watered with money. And they've been drying it out, and they're going to get to a certain point where they're going to look over and say, oh my gosh, if we don't put some water on that plant, it's going to die. And then they'll spring forth the fountains of money out there. And again, like they did it during COVID. You saw what happened to the markets during COVID. COVID was coming in, the markets were rolling over big time. And then what did they do? Stimmy checks for everybody. And what happened to the markets? We saw them go up from, well, let's take a look. It doesn't hurt to just look again, Take a look. Go back, where we catch it here? Going all. COVID at the beginning, 5 year. Let me see. It was back. Just missing it on the 5 year here, but it was way down in the 20s, and then COVID come along, and then they pumped all the money into it, and we saw it go up to 45,000. It doubled the market, the amount of money that they soaked into it, and they're going to do the same trick all over again. It's going to be at its ultimate low. I don't know, maybe 32,000 or 28,000 even. And they'll have big trouble. Banks will be starting to go under. Everything will be starting to deflate, and they'll probably have a real print of a deflation of maybe 2%, but they'll be saying it's still 1% above. In other words, and so in other words, we're going to shed. Right now, they're saying that the CPI, uh, where is it here? Uh, right now they're saying that the CPI is what, right, running around a 2.4% handle or 2.8%. Well, you see it get down to 1%, then we're in it. This will drop. It'll shed down to about 1%, but we'll really have negative 2%. That'll be the real measure. That's when they're going to come out and stimulate. They'll be throwing money around. They'll do helicopter money if they have to. That's why I was talking about UBI. That's basically helicopter money. They'll do that if they have to. And you watch the markets turn around. It's not. I'm thinking to myself, 50, 60,000 Dow. That's what I'm thinking. In my mind. Uh, on the other side of this, and I'm thinking gold in excess of $10,000 on the other side of this at a certain point, maybe a couple years from now, a year or two or whatever out, after they do all this monkey shenanigans, because they got to catch up. Behind the scenes in the financial system, the dollar's on an exponential losing value, right? But what they've been doing is artificially, everything they do is artificially propping the dollar up during the last administration. I think that's over. I think that we're heading into full modern monetary theory. It's the print until the printer runs out of ink. I think that's where we're headed ultimately. They're going to kill the dollar in the end. It takes a lot to kill the dollar, though, because it was the world reserve currency. I say was the world reserve currency because I just see more and more nails going in the coffin of the dollar. They're slamming it shut and they're putting the big long spikes in. Listen, guys, thank you for listening to my show. Sunday, I'll be back again for another show. And thank you to my audience out there. I really appreciate you guys. Bye bye.